Good afternoon, everyone. Happy Prime Day. I wanted to be the first to wish you that, even though it started a couple of days ago. With that said, we're going to talk about zero DTE butterflies. We're going to look at a showdown between the standard butterfly, the skip strike butterfly, which I introduced just the other day, and last but not least, the open wing butterfly. Now, that strategy, as far as a zero DTE trade, I haven't really seen many talk about it, but it is definitely an interesting strategy overall. So today we have a PowerPoint. I'm going to try to get through this in 30 minutes. We're going to try to shorten up our presentations a little bit based off of the feedback that we've had. And then we're going to get through the presentation. You can ask some questions along the way. I had some sound issues to get started here, so we're a couple of minutes late, and I just said, let's just put the headphones in. So you get to look at my ugly mug with my iPhone headphones in. But with that said, let's get started. All right. Oh, by the way, my name is Brian Overby, and I am the Senior Options Analyst here at OptionsPlay. All right. Every Thursday, we do education. A lot of great events. And I'm going to reference one that I watched a couple of times now. There is a zero DTE seminar that Tony, both of them I've worked with previously, Tom Sosnoff and Tony Zhang. And it's about an hour long, and it's very easy to find inside our website and just by Googling it, actually. But that's a great presentation that I'm going to feed off of. And then last week, I introduced skip strike butterflies, but I did it more as a directional trade. Today, we're just going to talk about doing an at-the-money butterfly with 1 day remaining to expiration. I put the quotes together that I'm going to use in the presentation at the very end of the day. I tried to do that on purpose so that we can have an actual actionable trade tomorrow, if you will, and that will be a 1 day trade. And I'll talk about the dynamics of when to enter the trade and when to get out of the trade. And a lot of this feedback is out of my own experience from doing them, but was solidified by the conversation that Tom and Tony had, because Tom's got the analytics that's behind it. So, wonderful day to talk options. All the stuff that we talk about today is not meant to be a recommendation. There's going to be trades that are real. We're going to look at some real quotes. The market's closed. They won't be real time. But, well, I guess they'll be real time because the markets are closed, if you can think of it that way. But with that said, past performance is not a guarantee of future results. And we always got to say that. We don't know who we're talking to out there. If you do have any questions, too, during the show, please do put them in the Q&A box, and I'll try to address them. The chat box, chat amongst yourselves. Have some fun. Be nice. But with that said, I don't really pay a lot of attention to that. There's a lot of people that log in a little bit late. I kind of try to peek at it every once in a while. But if you want your question answered, click on the box that has the question mark. All right. In order to join OptionsPlay, get up your phone right now. Scan me here, get a 30-day free trial, and you can log in. There's no expectations behind it whatsoever. Check out all the software that I'm going to show you today. We do a daily play, and I work with Tony on this. Tony usually puts out a research report that I'm going to highlight here on the very next slide. And I will take a lot of those stocks and apply daily plays to them. We got earnings season coming, so there will be some interesting plays, and we've already done a few that are going to be centered around earnings. And also every Monday, Tony does a research report, and Tony does this via YouTube, and you can register now, and you'll get an update every Monday morning. We won't, spam you about it. But we will let you know that, hey, at 8:45 a.m. Eastern time, there is going to be a seminar, and we're going to talk about some stocks. And Tony does a great job of going through his research that he puts together. And he does it every week. Actually, he puts it together a couple of times a week. Sometimes the stocks change, sometimes they don't. But if there's any updates to his research, he always addresses it in this 1 hour seminar that he does. And he's trying to shorten it up a little bit, too. Talk a little bit more about the actual stocks that he is trading or that we are researching, and then also and talk a little bit less about the actual sectors. That's the way we're looking at it. All right, so if you look at options, there are four basic trades. We're gonna combine all of these today. I'm going to get bullish on the skip strike butterfly by using the puts over here on this side. But mainly we're going to start looking at calls. Now, you can apply these in any direction. And these trades that I'm showing you aren't necessarily meant to be like, oh, tomorrow's a great day to do a 1 day 0 DTE butterfly, right? I'm going to put them together just so that it's a very simple, succinct, in a very simple, succinct format that can help you decide, because I do think that there are different times where these strategies do apply. And so with that said, let's just start right away. Let's start running and look at just a butterfly. And I'm just going to go through the dynamics of a butterfly. Butterflies are some of my favorite trades, and it takes a little bit to get there, but butterflies down on the trading floor, back in the day when there weren't option pricing calculators everywhere and fast moving computers, the market makers on the floor always used butterflies to make sure that they had their quotes right. Because if you're doing a butterfly, you're buying something that's in the money, selling something in this instance that we're going to talk about that's at the money, and buying something that's out of the money. You had to make sure that your quotes lined up with your butterflies because you didn't want to give away the butterfly for free, right? And there were firms that would go out and try to buy a standard butterfly and get it done for a net credit or for free because the market makers weren't quoting right. And that literally was a thing back in the day. So that's how important butterflies are. This is one way to make sure if you're looking at butterflies and you're doing a standard butterfly and you ever see that it's out of line and you say, oh, in the OEX, this is where I would see this quite a bit because it is the S&P 100 index, and it's an American style index that can be exercised early. Sometimes you get butterflies that will be trading for, they look like they're trading for a net credit, but they'll never get executed at that. And just that simple. So here's our max reward when we do it. It's the difference between the strikes, and we're just basically going, I'll call this strike A to strike B, that difference minus the net debit paid for the trade. Now, when you're doing a butterfly, on paper, they're beautiful. At expiration, they're beautiful, but you should never hit a home run in a butterfly. You just really shouldn't, because, and I always make the joke that if you do, you should get the stupid award for doing that, mainly because you should have got out of the trade earlier. Like if you put a butterfly on and you paid $2 for it and the max gain is $10 and you sell it for $4, you had a great butterfly. You made $2 on your butterfly. It takes a while for them to get to that max. And if it hits the short strike and you're on the last date of expiration, you really should get out of the butterfly and realize that it's almost impossible to make that thing stop right at the peak of the butterfly, right here. So butterflies are trades that they move slowly, and that's why they're interesting in the 0 DTE environment, and they have high theta. They like theta, even though you pay a net debit for it. If you're correct on your forecast, you want time premium to go away because you're selling two of the at the money butterflies. And they have, in the 0 DTE world, they have high gamma and high delta, but almost everything else does, right? The gamma pushes delta in either direction if they go in or out of the money. So the break even is the lowest strike would be this strike plus the net debit paid. And that's where we cross the x-axis. And then here, the break even is this strike minus the net debit paid. Okay, so little risk, big reward. We never get that big reward, but interesting dynamic in a market where you think it can stay stable. We're going to center on at the money butterflies, and that's what a lot of 0 DTE traders do. Okay, so open wing. This might be the first time hearing open wing, and if it is, put it in the chat box. I already have a question from Steven, but we'll address that in a second. Go in the chat box and let me know if you've heard of open wing. If you've followed me, you've heard of it. If you've followed me, you can follow me on x.com. My handle's at Brian Overby. Never. All right, Rick. That's a strong never, too. All right. So let me talk to you about this open wing butterfly. And I kind of like it in the 0 DTE environment. And I'll show you what the risks and the trade-offs are that are involved with it. So if I look at the open wing butterfly, it's the same concept of a standard butterfly. They're going to be a little bit more expensive, but in the zero DTE environment, time decay is time decay. So you pay a little bit more up front, but ultimately the risk versus the reward in a zero DTE standard butterfly, the reward is always much higher than the risk. And it's the way butterflies are set up. So if I pay a little bit more, I do got a little bit more risk, but I can manage that by the number of contracts that I'm trading. But the same dynamics can help you in an open wing butterfly as opposed to a standard butterfly. And here's why. Okay. So the max reward goes the same thing. It's the width between the strikes of the long vertical. Now I had to add long. You could say debit. With calls, it's going to be this strike right here from here to here. In the standard, it doesn't matter, but in here, so you take whatever strike A is here, minus strike B, if we're doing this with calls, and then you minus the net debit paid, and that's your maximum upside. You only have one break even. Now, in our trade that I put together today, we're going to be right here. We're going to be very close to the zero line when we do it. But here's what the difference is. We're going to pay a little bit more for the butterfly, and if the long vertical or the long call spread is, let's say, and I'll do it with, I'm not going to say SPY. I'm going to use SPY today because that's what we support in the OptionsPlay platform. But with that said, if it's 10 points wide, if this is a 10-point wide long spread, then the short spread's only going to be 5 points wide, which means you don't bring in as much of a credit, right? So if you go back here, and I'll jump back one slide, this is the short spread, this is the long spread. They're both the same width, and because of that, you get more of a credit from the short spread to help pay for the long spread. Okay, over here, we're going to say that this is the same width as our standard butterfly, but our short spread is cut in half. And you can decide how much risk you want, how much reward you want. But if this is 10 points wide and this is 5 points wide, if at expiration the market goes up, this is going to trade for 5 points. So you don't have the upside risk on the trade. I like these around earnings events, and that's what I talked a little bit. Well, we talked about the skip strike in the last event about zero DTEs, which I'm going to introduce next. But I like these around earnings. I mean, it's obviously, to me, an alternative to a long call spread also, right? A long call spread, you buy this one, you sell that one. You pay more for that long call spread, but then you have more upside. It's always trade-offs, right? You get more upside, you usually got more risk. That simple. And so this is an interesting thing when you have stuff that has high time decay. So this is called open wing butterfly with calls. The break even is going to be this strike plus the net debit. You're not getting it done for a credit. You're paying more than the standard butterfly. And the max risk is, once again, just like the standard butterfly. It's this direction if the market goes against you, and whatever you paid for it is your max risk. Break even, this plus that net debit, that's where we cross the zero line. Okay. Superfly, John says, that's awesome. All right, let me address Steven's question and then I'll get into the skip strike. When I read Michael's book on understanding options, he suggested as far as spreads, do them in the money because the probability of making money is greater. And you're excellent, by the way. Thank you so much. That just, you know what? The alternative to doing the in the money spread, Stephen, is to do an out of the money short spread using the opposite option. You know, they're synthetic relationships are what they are. So yeah, and out, like if you're thinking about an in the money call spread, that's the exact same risk reward of the same strikes out of the money put spread. So they're synthetically the same. So the point is moot, and he should have mentioned that. But I don't know Michael personally, so I don't want to But that's synthetic relationships are an interesting conversation is about synthetic relationships, and it just lets you develop an understanding. Like the most simple one that is out there is that a covered call option, or well, actually, I'll go the opposite direction. The simplest one to understand is that if you buy a stock and buy a put, right? That is the exact same profit and loss graph as a long call. They're synthetically the same. They have the same risk rewards. Even when it comes down to the money, they're the same. You got to pay more to own the stock and then go out and buy the put, but the put will be priced a little bit lower than the call because of the cost to carry on the stock. It's the marketplace is amazingly efficient. And so just interesting. If you want to keep going down that road, Stephen, look up synthetic relationships. You won't see a lot of things in YouTube about it just because it's, you're just saying this thing looks like one thing looks like the other. It's a kind of a Sesame Street show. All right. Should we call it the Brian Fly? No. The only strategy I've ever named, William, is the fig leaf inside the playbook, and it has got legs as opposed to a leverage covered call. And I always like to call it the fig leaf because you're kind of covered. You're buying the deep in the money call as an alternative to the stock, and you don't own the stock. So if you get called away on the shorter term option, you got to do something, and that's why we came up with the term fig leaf, because you're kind of covered. The brokerage firm thinks you're covered, but you still got issues if you get assigned. All right. Awesome. Thanks for the comments. Let's get to the skip strike butterfly that I did I don't know, Tony might have did the one in between, but the last time I did an options play education event on a Thursday. And here's the skip strike butterfly. Now, I like this as an alternative to a short spread. All right. And I think of it more as an alternative to a short spread than I do to a butterfly, but it's another modification that you can make on butterflies. And what you're going to do here, we're going to do a skip strike butterfly with calls. Actually, this is where you sell this for a net credit to the account, right? And if the market goes down, you receive that net credit in this instance. So in the skip strike, we literally skip a strike. Now, people will call this modified butterfly. They'll call it a broken wing butterfly. I hate that. I don't hate them. But the skip strike literally means that we skip a strike and we embed a credit spread into the trade. So if you have the butterfly, right here is the strike that you would skip, that would create the standard butterfly. And when you do that, you have you embed that credit, and that credit pays for the butterfly. So by doing that, you add additional risk, but you make it that if the market goes down in this instance, that you are going to benefit from this trade. So we'll look at this. I changed it up a little bit on the real life example to try to keep the risk in the same direction, and I did it with puts. But everything that we're talking about with calls, you can do with puts. So here you go. The max reward is the width of the long vertical plus the net credit received. That's the maximum reward. So you're hoping to get it done for a net credit. So you actually have more upside because you're establishing this for a credit. What's wonderful about skip strike butterflies is it's possible to put it on for a net credit and take it off for a net credit. Ooh, right? How awesome is that? Try doing that with a short call spread. You can't. You can actually put this on for a credit and then receive a larger credit if it ends up close to your strike. All right. Break even is a little bit harder to figure out. You got to actually use the skip strike plus the net credit received if established for a credit. But very rarely are you going to do these trades and not establish them for a net credit. But guess what? That's what I did. Mainly because we did it at the money. These trades to me are a little bit more directional focused, right? If you're looking at the SPYs, the SPY would be down here, right? And you would do it more like a short call spread, but we're going to look at it at the money anyways. All right, so to take it one step further with the skip strike butterfly, This right here, from the strike that we skipped to go on down, is literally a call spread, a short call. I said bear, I should have said short, but it's a bear call vertical spread. So from that strike to that strike, that is the risk, and that's going to be the risk in the skip strike, just like if you did the bear call vertical. Now, the trade-off is that if I do the bear call vertical spread or the short call spread, I bring in a net credit to the account that is larger than the skip strike, right? In the skip strike, we're paying for a cheap butterfly, but it has the hedge built into it. So here is the skip strike. Imagine we're embedding that credit spread. And how do we do that? We just skip the standard strike. And usually it's the same with the way. So if this is 5 points wide, you skip the strike, and then this would be 10 points wide, but your risk is only 5 points, which is the width of the short spread. That simple. All right. And so by the skip strike is basically the butterfly plus the short spread equals the skip strike butterfly. This strike and this strike, you're buying that one in the butterfly, you're selling that one in the bear call spread. So why not just skip it? That's another way to say it. So I have about 5 different ways to explain this. I like this strategy, and I did it as a 0DTE a couple of weeks ago, but I like it in certain situations, like Amazon always likes to announce on a Thursday. You have a 1 day remaining after their announcement, Thursday after the close. I like looking at these type of trades because the butterfly needs time decay to happen, if you're correct. You need this strike to go away. You want that time premium gone. And so that happens quickly on a 0DTE option contract. So there's some fun little nuggets that are in the last presentation that I did on 0DTEs, okay? So skip strike butterfly with calls, we already went through that. So, oh man, what happened to my third one? I'm missing my third screen grab. Well, all right. We'll do it live. We'll do it live. The markets are closed now, so they're going to be a little bit more, nothing's going to be moving around. But I was going to look at all 3 of them, and this is what I say. Here's the Smackdown. Here's the Showdown. Here's the Battle. If I'm doing a 3-point wide butterfly in the SPY, and we're going to talk about the SPY. I prefer the SPX because of assignment and cash settled. But the OptionsPlay platform doesn't support it. So I'm going to use the platform to go through these. So I'm going to do something as an alternative. And we've been looking into it. No guarantees whatsoever if we're going to support it. But it's been discussed. Let's put it that way. We're not a brokerage firm. Obviously, we connect to brokers. But with that said, the quotes aren't free when it comes to the SPX. They're not free in general, but in particular, the CBOE has a monopoly on the SPX options, and they charge you for the quotes. So here you go. I really don't know what happened to that stupid skip strike that I had, but here you go. Market is at 626 and change, so it's very close to that. I like going about 3 points away, 2.5, like in the SPX, you could, if we're in the SPX, that would be 30 points, right? Because you times it by 10. In the SPY, it's 3 points. When you're 30 points wide, it's easier to manipulate the strikes a little bit more because we don't have half-point strikes. Well, some of the strikes are half points, but most of the time in the SPY, you don't see half-point strikes. So we are going 3 points wide. That would be 30 points in the SPX. 3 points wide, and I did this at the close today, about a half hour before the close. I did that on purpose, and the midpoint is 97 cents. So the reward is $2.03, the width between the strikes plus that. So you're paying 97 cents, and obviously a solid risk reward. But if I put this on for $1 and I could take it off for $1, I'm definitely going to do that if I made 100% on that trade. Now, here's the open wing. And here's what all I did in this trade here is I only went 1 point difference because, once again, we're in the SPY. So 623, 626, the 29, no, the 28. We pay up for that. Here's the difference in cost. This is 44 cents. Here, this is 76 cents. Midpoint 129. So we are paying 30% more, but we still have a very good risk reward. We're still risking 129 to try to make $1.71. We're paying 97 cents to make $2.03. Very solid risk reward, but we don't have the risk to the upside on that trade. And then if we did the skip strike, I actually put it together with puts, and I literally don't know why it's not there on that slide, but okay. Maybe it's on the next one. Nope. All right, so we'll run to the OptionsPlay platform, and I'll put together that skip strike. It should be fairly close. We're going to do it with puts because in this instance, if we put this all together, our risk here is to the downside, right? So if we lean to the upside, if the market goes up, does anybody know if, let's say the market goes to 630 tomorrow on the close, and by the way, these are 1 day, right? So they're 1 day option contracts. What would this have to be trading for? See if you guys are, you can take a drink of coffee if you need, do whatever you got. $2, says Dan. William says 4. Now remember, it's not going to be worth 4. The maximum it could be worth is 3. Oh, you're adding 1 to it. I see where you get that. All right. The width between the strikes is 3 on the long spread. The width between the strikes is 2 on the short spread. Because of this, now this is the open wing, this has to trade for 1. So if the market goes up, we paid $1.30 for it, $1.20, well, I'll round off $1.30. This thing at 630, $630 would have to trade for $1. You would make $3 on the long spread. You would lose $2 on the short spread. It has to trade for $1. If the market finishes at 630 on this one, we're down $1, right? We're down 30 cents, we're down $1. We're down 30 cents, we're down $1. That's the difference. Now, the market goes down below 623, we lose $1 here, we lose $1.30 here. So, 6 1/2 dozen the other. The risk reward stays the same. You still have the huge rate of time decay. You still have high gamma that's going to drive delta. You still have all that stuff, but you got to pay a little bit more up front, which means you got a little bit more risk. One less commission? No. I mean, you're still going to be paying commissions. The commissions will be about the same. The fees will be about the same because you still got 3 legs. You still got 3 legs. You're still looking at 1, 2, 3, 4, right? 1, 2, 3, 4. So you still got 4 contracts. Yeah, Jay got it, by the way. Give a shout out to Jay. Jay said it was 1. That's what it'll be trading for. And that means you'd be down 30 cents on the trade. Okay. I am going, this is the skip strike example that I did in NVIDIA. And I'm going to I'll bypass that for a second and want to bring up the slide one last time, give you a chance to sign up for the 30-day free trial. If you would like, scan it right here. Check us out. A lot of great information. Like I said, earnings season is coming. So we're going to be doing daily plays. We send them out in the morning. They're actionable, but it's not a active trading situation in that we're giving you, it's noon, it's time to get in because this stock just broke through to the upside or something. It's a daily trade signal that you can use to try to come up with ideas and apply your own risk parameters, which we do a lot of seminars on risk parameters along the way. Okay, that's me. It's my ugly mug. X.com is at Brian Overby. OptionsPlay is the website. My book is OptionsPlaybook.com. Check it out. Let's exit. And like I said, I had sound issues, so I had to restart my computer about 3 times before I decided just to put in my headset. Okay. SPY, and I did have the first trade all set up, but here's the way we're going to do it. Because if you look at the slides, we want the benefit to be if the market goes up, right? So on the standard, you want it to stay in the middle. If you did the open wing, you either want it to stay in the middle, or if it goes up, that's your best case scenario. And on the broken wing or the skip strike, I'm going to do it with puts, and the credit in concept would be to the upside. In other words, the best worst case scenario would be if the market went up. Okay, so let's go with the bear. Let's just look at puts. I'm going to modify this trade. Go right at the middle here. We're going to go SPY. We're in the SPY. We're going to go 1 day. I literally had this screen. I have no idea how it did not show up in my slides, but okay. And we're going to be selling 2 of these puppies. 630. So this will be 3 points wide. And I'm going to keep it similar. We're not going to get this done for a net credit. And we're doing it at the money. It would be hard to get anything done for a net credit based off of that type of setup, even in the SPX, right? 630 on the downside is going to be 627, 3 points down. No, I'm sorry. 622. Where did we end up at? Yeah, it's a little bit higher than when I put this together, but not much. So on the downside, 630, then we did 3 points, 625. Apologize for the patience. I had this all set up before. And then now, on the open wing, we went up to, let me go back to here. Were we going 3 points wide? Yeah, we got to go 23.26. Okay, so the market actually went down since I put this on. All right. So the market actually went down. So we're going to go 23, try to keep the strikes the same, 26. And then we would do the 28 on the open wing, 29 on the standard. I'm going to go 30. And I'm not literally skipping the strike. 630. Oops. Dang it. 626. Add a put. 630. All right. So we're adding a $100 requirement. So let me go and show you how this, it's so tight because we got the SPY instead of the SPX. But notice right here that we are down on the position, and right here we are down in this direction too, but we're down more if the market goes up in that scenario, and we're down less if the market goes down. Yeah, let's flip it around. Let's do the call side. Oh, that's why. Okay, because I did this. So the skip is there, 23. This is what has to happen. And we're going to go 29. Yeah. So now we're paying a little bit less. And it was about 25 cents less than we did on the standard Butterfly. 25 cents less. Now it's only a dime because the market went down. Screwed up my whole thing. Gosh, darn it. But we have one more point of additional risk. So now if we look at it this way and we pull this up, there we go. If it goes up, we lose less than if it goes down. Okay? If it goes up, we lose less than if it goes down. And like I said, the skip strike is a little bit different in that it's a lot more interesting in the SPX. It is than in the SPY. And usually I'd put a little bit of a directional spin on it. I might do this a little bit more out of the money on the put, trying to get it, so that if the market stayed up above my Butterfly, I lose less in general on the trade. But the maximum loss on this trade would be if we paid what we could have paid, 75 cents, plus that $1 that we embedded, that credit that we brought in for doing the trade. All right, apologize for that. I kind of botched it. Here's what it is. If I go back and I do the trade-off, so let's go in and do the open wing. I think that's where we got the most interest. So we're going to go back and let's use this. Let's do the bullish. Let's go modify. And we'll set it up. I guess we'll do the exact same one that was in. The market was at 626.35, I think, when I did the ones for the slide. We'll do this one right now and we'll look at it. And we'll compare the open wing and then we'll do the smackdown. I don't think anybody wants to do the skip strike, which is fine, but there is a time and a place for it. But the smackdown will be between the open wing Butterfly and the standard Butterfly at the money, 1 day remaining, because we're doing it right now. So this would be like filling it on the open if the market stayed where it was at. And we'll look at these two trades. In the SPX, this would be 30 points wide. Okay, and you'd be paying 30 points wide would be about $5 is where we would be looking at 30 points wide on the trade. Well, actually it would be a little bit more, I think, because the SPX came down and this is trading for around $1 on the trade. So you know what, I'll pull it up on a different platform and I'll give you an idea of what the 30 point wide SPX is at. Okay, 625, and let's look at 628. We're on the call side of things. Does help if you do use the 1 day and a 1 day seminar. So this is a 0 DTE one now. Add a call and 622, 625, and 628. All right, everybody check me here. 89 cents. All right, only because, like I said, the market's down a little bit more. So I'm going to write this down. Let's call it 90 cents. 90 cents on a 3 point wide Butterfly. Risking 90 cents, maximum is $3 on the trade. Now, if we go back and we look at our profit and loss graph, that's what we look like. We stare at this trade. Now let's go in and let's do another trade, and we'll use this one to put this one in, and we will, well, let's keep it here because then it's just simple. I'm just gonna look at the cost of this trade. So we'll modify this, and this is 3 points wide. So let's just bring this down to 627. All right, 126 now. So I didn't lie to you. It's always about the same, a little bit difference in price. So this is 127 at the midpoint right here. Still have 3 points of upside if it stays at 627. But the difference here is 3 points. Difference here is 2 points. If it goes up, it's going to trade for 1, which means you would be down 30 cents if it finished above 627 at the expiration tomorrow. We hit the profit and loss graph, and we'll zoom in on it. And you look at this trade, once again, lose less here, lose more here. The dynamics are the same. The dynamics are the same. We'll click trade, and we'll go Command 0 and go right back to where we were. In that, I still want time decay to happen. I'm still selling a $2 option contract that's almost all time premium. And it doesn't matter. This is your battle. This is what you want to capture, is that $2. Put it on in the morning, take it off in the afternoon. If you are wrong and the market goes up, we lose 30 cents. Market goes down, maybe you manage your risk. But now you don't have to watch it quite as closely as you do with the standard butterfly. You can look at the skip strike too if you want to do it that way. But the skip strike, like I said, because of the strikes, it would be a little bit more interesting to do in the actual standard butterfly. Why don't you try to pin to close? Okay, William, here's the thing about these trades, and these are great questions, and I got a lot of questions in the proper spot in the Q&A thing. But here's what I'm going to do. I'm going to take these, and I'm going to create a portfolio, and we're going to call it Butterfly. Well, yeah, we'll just call it Butterfly. And I am going to send these trades into my portfolio, and we're going to paper trade them. And if you sign up for the 30-day trial, you can do it right now. Or if you are already a member, first of all, thanks for your membership. And second of all, you can trade right along with me. So we'll put that in, and then we'll adjust the second one. But it's going to end up putting them both together, unfortunately. It's going to end up doing them both side by side. But we'll keep this one in. And if you go to the portfolio and you take a peek at the watch list, there is our Butterfly. 126, good for the day on the call side of things. And there's our cost basis. And then if we want to close it tomorrow, the market, I don't know, a couple hours go by. And this is what's beautiful about this. And you click close position, and it puts it all in. And then you hit trade and add to the butterfly position. And all these are closing. All of these were opening, and it maxes them out, and it closes off your position on the trade. Okay, so now let's talk about the trades. Let's address Chris. Let's get Chris here. We're almost out of time. Chris says in the Q&A box, why would you do a 0 DT butterfly instead of a 20 delta iron condor? He says, becoming a big fan of the skip strike. I do like the skip strike as an alternative to a short spread. Maybe at the money on a Adobe, Lulu, and NVIDIA. Thanks for the great info. It's a different trade, Chris. I don't mind the iron condor, but the fact that you're selling 2 at the money option contracts and you're getting such a big amount of time premium because of that makes it particularly more interesting to me in a 0 DT environment to do an actual butterfly which is honestly just, they have iron butterflies where you sell a call spread and sell a put spread, and you just match up the middle strikes. So it is the stepchild to the iron butterfly, or I'm sorry, to the iron condor. But because of the time decay of these at the money option contracts on a 0-day environment, I like at the money butterflies better in a 0-day environment than a condor. Condors to me are more longer term trades. I can adjust them, like to do them in the SPX, at least 45 days out. And then that time premium is your protection. You can go a little bit wider and bring in a different premium. I like iron condors on longer term. I like butterflies on shorter term. SPY is resistance at 626.28. Can we expect to break above resistance? Well, Jim, actually that's a good question in all this. If you're doing this and you see a resistance level and you think it's going to struggle to get through that level, this is one, it might be a reason to do a 0 DTE trade. Right? That's simple. Now, if you want to get into a little bit more on the dynamics, and I will try to address that a little bit. I don't see any other questions in the Q&A box. Remember, I'm only addressing the Q&A box as much as possible. Okay, Robert puts one in. I play 0 DTR and get out at 25%, and that's fine. When would you get out on a 0 DTE butterfly? This is exactly the question that needed to be asked, Jim. I would treat it the same way. I wouldn't change my attitude about what I can make. And I kind of emphasize that. I danced around the concept that you're not going to hit a home run. And if you expect a home run and you get a home run, then you should receive the stupid award because you should have been out earlier. So I don't mind doing the at the money standard butterfly and trying to make 25% and then getting out. I don't mind that at all. And then you're going to manage your risk. Can you tell me what you would consider your risk on the opposite side if it goes against you, Robert? Because you're probably not adjusting it, right? You're probably just closing it out. Or do you let it just run, which is okay too. Don't mind it. Yes, Jay, if you're doing a weekly trade and you're doing these butterflies, yes, you would widen it. You would definitely, because once again, you're trying to hit the bullseye when you're doing a butterfly. So you want your wings wider. If you go out further in time, they become immensely cheaper if you add 2 days onto them. So yes, I would probably go wider because you can. Because you can. Okay, so Tariq, if you want great detail on the trade management, I suggest the 0 DTE conversation that Tony and Tom had, and I'll enlighten you a little bit on all of it, okay? And I think that this might have been where Robert came up with the 25% max profit. On the upside, if you're doing 0 DTEs, the most adapt time, and I always felt this way, and then the math that Mr. Sosnoff has done behind it kind of solidifies it. But if you're doing 0 DTE, the last hour to expiration is scary, period. I don't care if you're in a short spread, even if you're in a long spread, or you're long an option. The last hour is crazy, because if you're in, that thing's going to run hard. If you're out, it's going to disappear quickly. Very, very high gamma that drives delta to 0 or 1 very fast. So every single strategy in a 0 DTE world, even in big underlyings like SPY, a $625 underlying, or SPX, a $6,000 index, these options got to go to 0 in an hour, right? So my attitude on the SPX and the SPY is you put it on in the morning and you look to get out by noon or 1 o'clock, somewhere in that range. From 1 o'clock on, it's a much different game to trade in the zero DTEs, no matter what strategy. Very true about butterflies though too. So if I put it on in the morning and it hits one of my strikes, I'm out, right? Today the SPX moved $6.25 up $1.76. So it obviously would have stayed within the range, and that is a third of 1%. So if I did this trade and the market at one point in time got down to 622, I'm going to get out of the trade. Once it gets out of the money on my standard butterfly in that range, I'm just going to get out. Now, if it went up on this is our open wing, right? Because we got this open wing, you can let it come back. So that's another benefit to doing this trade. We're going to be down 30 cents. If it goes on up, I paid an extra 30 cents, but now I know what I'm going to, the maximum loss is going to be. And it may come back and get within these strikes and kind of reward me. So another reason for the open wing that nobody talks about. So do you guys want to vote? You want to vote on it right now? Which one do you like better? Would you rather play less and do the standard, or go in and do the open wing? Actually, let's change this up. So we got the butterfly here, and I just realized that you got to be smarter than the platform. So if I click out of this and we go back to the SPY, we can set up a different portfolio and we can trade the butterfly in that portfolio. So that's the standard. Are you guys voting? Standard. Everybody wants the standard. I got no open wings. Just go OW. OW. Chris is still standard. Wow. Those must be Iron Condor traders. Steven, I'm disappointed. All right. Too fussy. Thanks, Robert. Jay, open wing. All right. Open wing. And then it lets you lean a little bit better, bullish, doesn't it, Jay? All right. The open wings are starting to come in. I guess I talked some people into it. I like the open wing too. I like that trade. I like the fact that you can leave it. And if it goes against you, you just like, oh gosh, I hope it comes back. And you can modify it. Once again, you're in the SPX. You can make it so that ideally you would do it so that the open wing of the trade, if the market went up, you would have to pay a little bit more for it. But if the market went up, you would be profitable on the upside. Maybe a nickel, maybe even a penny, maybe even break even. But bottom line is you would still only have exposure to the downside. You still have that still at the money selling two of them. Okay, so let's modify this here. And we will go 625, 628. Add a leg, 628, and then 629, and that's the standard. 107. Why is it saying 107? 108. The markets must have widened a little bit. That was 98 cents not that long ago. 108. Oh, no. That's because what we did something. Yeah, that's right. We did the skip strip. We did the different one. Okay, so let's call this, let's add a portfolio, and let's call this standard B. And create that one. And then we're going to add that position. So now if we go into portfolio, and we can hit our portfolios, and we can go butterfly, and we can go standard B, and we can put them right next to each other. See, got to be smarter than the platform. So here's the issue is if I put them both in butterfly, they would all be in one position and it would just muddy the waters. But by doing this, I can see this butterfly, which is 625, yeah, 622, 625. This is the open wing, and this is the standard. 107 versus 126 is what the cost is if we look at those two trades. Well, Robert, you can enter it as I don't know. That's a weird question to me. How fast can you enter it? You can enter it fast. Ronald, open wing. All right, there we go. Peter, open wing. There we go. Kamal, open wing. William, no guts, no glory. I've never done that trade before, William. I don't know what that trade is. If you explain it to me, maybe we can do a webinar on it. The no guts, no glory trade. 625, 628, 629 is not standard. Doggone it. Very, very, very good point. Well, I'm going to let it go. So I think that's why it was more expensive. Yep. That's where my befuddlement was. All right, let's close it. I'll do it for you guys in case anybody actually comes back and watches the recording. Let's close the position. Trade it. Add to the standard. Yeah, it's not showing up. All right, I'm just gonna let it go. Any other questions that we have? If not, let's go back to here. This is my name. And here is, once again, the QR code if you want to scan that for your phone. Check it out. Or you can just go to optionsplay.com and sign up for the free trial there. Thank you, Jim, for your reply. In the playbook, I don't have the open wing yet, but there is a new version coming. I'm thinking about adding the open wing and getting rid of one other strategy that I haven't talked about that much. So there's going to be a new book coming shortly. Keep the fig leaf. Thank you. I do love the fig leaf name. Keep that rolling, William. Keep that rolling. If you Google fig leaf option strategy, it does come up. All right. Thank you, everyone. Let's call it a day. I'm 15 minutes over of my half hour, and I appreciate all the great questions. But we always get such a great crew and such a great response from our educational events every Thursday that I always like to. Sometimes I talk too much, but I have a passion for this, and so I will finish it with my line in the end of the playbook that says, "This is it for today's event. I hope that all the options that you buy finish in the money and all the ones that you sell finish out." Thanks for tuning in.